In July, Argentina witnessed a dramatic 13% spike in its official exchange rate, pushing the peso to around 1,380 Argentine pesos per USD, precisely the level previously flagged by the IMF as consistent with restoring external equilibrium. This marked rise corrected what the IMF had earlier described as a 15 to 25% undervaluation of the currency during negotiations in April. Faced with this surge, the central bank launched a forceful monetary response. It plunged approximately $3 billion into futures operations to stem expectations of further devaluation, bringing its gross futures position to $5 billion by mid-July. While these interventions didn't deplete official reserves directly, given they're denominated in pesos, the IMF warned that relying on futures should not supplant broader monetary and interest rate tools. These measures ran alongside broader shifts in monetary policy. The central bank raised reserve requirements and short-term interest rates sharply, with interbank lending rates soaring around the 30% mark. These steps were clearly aimed at mopping up excess liquidity unleashed following the dismantling of lefty instruments and the slower-than-expected migration to LACAPs, which delivered surplus liquidity to the economy and fueled demand for dollars. The markets responded rapidly. The IMF's board approved Argentina's first review of its extended credit arrangement, agreeing to loosen the country's 2025 reserve accumulation targets by $5 billion and to immediately release a $2 billion tranche. This approval came with praise for Argentina's commitment to fiscal discipline and structural reform, particularly in shifting to a more flexible exchange regime and curbing inflation. Investor sentiment improved sharply at the start of this week. Argentine equities and dollar-denominated bonds rose, with a Merval index climbing nearly 3% and ADRs in New York strengthening by up to 5%. Meanwhile, the official dollar rate eased modestly in wholesale markets to around 1,370 Argentine pesos, and parallel rates such as Blue and MEP edged down slightly after the IMF endorsement. Despite the immediate relief, underlying challenges remain. The prolonged reliance on futures markets raises concerns of a future build-up of peso liquidity that may reignite demand for foreign exchange. Analysts emphasize the need for clearer, longer-term monetary and exchange rate policy frameworks beyond short-term interventions. A continued fragile political environment ahead of legislative elections in October also feeds uncertainty and may reinforce dollarization tendencies among savers. In essence, July's surge in the peso-dollar rate brought Argentina's currency more in line with IMF benchmarks, a shift bolstered by decisive monetary action and the green light for further IMF funding. Markets reacted positively, even as the government seeks to navigate liquidity, inflation, and political risks in the months ahead.